One of the questions I often get from bond investors is to define the difference between investment grade bonds and junk bonds. And investment grade bonds sound like something that's great, something that's exciting that you want to own. And I would say that there are some of them you may not want to own, right? Junk bonds sound scary, like something I never should own. And of course, there are a lot of junk bonds you probably should never own, but there are some that might be okay. What those two definitions are is really an attempt to determine credit worthiness of a bond and to differentiate those companies that have a high probability of being able to pay back their debt versus those that have a low probability of paying back their debt. Now, if you're wondering what does debt have to do with bonds, then go back and watch the video on stocks versus bonds, where I give a real estate analogy that helps you clarify why bonds have to do with debt. Okay? The problem, though, is there are all different rating services that rate the financial stability of bonds. There's Moody's, there's Standard & Poor's, there's Fitch, and each of these has well over 20 different grades of creditworthiness. So to try to lump them together in two categories, investment grade and junk, is a little disingenuous. That's why I felt the need to further explain. So let's compare that rating from those services on a particular company's bond, which again is debt, is money the company borrowed from investors. And let's compare it to your FICO score, right? Each of us has a FICO score. The low end is 300, and the highest FICO score, credit score you could have is 850. Hopefully you're closer to the 850 than you are the 300, right, with any luck. But let's say that we were to go to a banker and get a mortgage together, or separately. And you have a credit score of 701, and I have a credit score of 699. And let's say that bank has a rule that their minimum cutoff for FICO score is 700. If you're over 700, we'll lend you money. Under 700, we won't. Now granted, if you have a FICO score of 850, we might lend it at a lower rate. If your FICO score is 701, we might charge you a little more interest. Okay, and that's just like what happens in the bond world. The lower your credit rating, the little bit more interest you have to pay to investors to get that loan. The higher the credit rating, the less interest you have to pay, which is why government bonds are considered the most secure, pay the lowest interest rates out there as a general rule. Okay? But let's say that bank, in our analogy, drew a line at a FICO score of 700. You'd get the mortgage because your score is 701 and mine is 699. But what if we dug deeper? And what if they found out that the reason yours was 701 is because you just decided at one point you wanted to not pay a student loan. And it was years enough past that you rebuilt your credit score, you're still up, you had the money to pay it, but you just decided I'm not paying my student loan. Conversely, let's say the reason mine's 699 is because I recently went through an ugly divorce. And my ex-wife promised me she was paying the credit card bills and she lied, she didn't pay them. And it pushed my credit down to 699. Once you know those subjective factors, now all of a sudden, I might be a credit risk, even though I'm 699 and you're 701. So a financial institution that simply draws a line at a certain number is being somewhat disingenuous, as I believe to the same extent that the rating agencies are being disingenuous when basically some human being years and years ago said everything above this rating is going to be called investment grade and everything below this rating is going to be called junk. The reality is when you're looking in the bond world, if you're a good bond investor, you're looking beyond just the ratings. You're looking at the actual financials of the company and you're looking at some of the subjective facts surrounding those financials. And not just looking at whether some human being put a title on that says it's investment grade or junk. And the two major rating agencies, just so you know, with Moody's, anything rated Baa or higher is considered investment grade. With Standard & Poor's, anything rated BBB or higher is considered investment grade. And again, there are well over 20 different grades with both of those rating agencies. So I hope this helped shed some light on this whole question of investment grade bonds versus junk bonds.